Hi, I am Professor Milligan. Welcome to my weekly series, Wall Street Wednesdays. I record this series live every Wednesday from 1 to 2 p.m. Pacific Standard Time on my Instagram account at Professor Milligan. Welcome to join me there or listen to the recording here. Enjoy. Thanks. Good afternoon. Good afternoon. As I always tell you guys, predicting or timing the market is virtually impossible. Anybody that tells you they can time the market and all that is just, again, full of themselves. Over the years, we've had people time the market and make great calls. Only after they made the great call is the following years or years after that they couldn't make those calls again. So they made it one time and didn't make it after that. A lot of people lived off their reputations of making those calls. Very difficult to make those calls and time the market. The signs are there. And one of the things that I've always noticed is that when you're in a bullish market, all news is good news. When you're in a bearish market, all news is bad news. So right now, the market's moving, it's bullish. It is what it is. One of the things that you'll hear me say and you hear all the time is don't fight the trend. And I'm not saying the market's going to new highs, although NASDAQ is at a new high. I'm not ignoring what's going on in our economy. I'm just saying that the market is always right. The stock market is the final answer. So anytime that you think that, anytime you find yourself arguing, saying, I'm right, even though the stock went down, the market didn't do what you wanted, and the market's wrong, realize market's always right. You're the one that's wrong. And we're going to talk about it a little bit today. The only reason because since we already started talking about it, let's finish up and finish talking about it. It's one of my strategies that can make you money, make some nice quick pops in a real short period of time. So, and what's interesting is for my former students who've been in class with me that I've often talked about strategies, I cannot remember ever sharing my secondary strategy to my students. My secondary strategy actually is more profitable than my IPO strategy only because there are so many more secondaries and it's easier to get secondary stock. It's easier to acquire, it's easier to get it. So there's a number of ways we can trade it. But I'll talk about that further in detail. All right, so let's talk about this now. Let's see. As you guys know, the market, again, is at a new high. NASDAQ's at a new high, closed at, I'm not sure what the numbers are. I turned the machine off, so I'm not sure what that. But NASDAQ closed at a new high. It's been running. And basically, it's the tech stocks that are moving NASDAQ. The tech stock sector is up, I believe, something like 15-20% for the year, and everything else in the S&P basically single digits or flat. So it is the tech stocks that are moving it. And when I went through and took a quick glance, most of your names, the FANGs, and FANG is who's FANG? FANG is Facebook, Amazon, Apple, Netflix. Although you'll see some that have swapped out Netflix and dropped in there Microsoft. So instead of having an N, it has an M. And the other one is Google. And when you look at them, all of them are at all-time highs. So you know what's driving the market. That's just what's driving the market. So do I still think we're going to have a pullback? Yes. I'm still short. It's going up and down. It's not a position where I'm trying to time the market. So don't think I'm trying to time the market. I'm not. But it's a position that I'm short. I think the market's going to have a correction. I don't know when, so don't get me wrong. Am I playing some things long? Yeah, no question. We're going to trade some things long. I'm going to trade some things long, and I'm trading some things long. One of the big things that's happening right now is we've moved into earnings season. So we're moving into earnings season. That's the first thing. The second thing is, after we move into earnings season, we also have our secondaries, which are coming left and right. All right, so let me do a couple things. We talked about the market real quick. Let me give you my commodity update. I always give you my commodities that I have fundamentally. I am a bit mad at myself. Wheat's been on my list for the last 2-3 weeks, and wheat has exploded today. Wheat was up. In fact, in most cases, whatever options if you were buying options on wheat, whatever options you purchased based on the move we saw today, if you brought anything near the money over the last week or so, 2 weeks, you basically doubled your investment today. So here's my list of things that I like in the commodity sector. Again, just to repeat for all you guys, when I give you my commodities, these are all based on fundamental analysis, not technical analysis. I do apply technical analysis to this, but right now it's fundamental analysis. So let's see. Ham, I will answer your question a little later. Hopefully you'll remind me, I'll come back to it. I can't even see it right now, but I'll come back to it and I will answer your question. So let me give you my list of commodities. On the long side, fundamentally long commodities, you have corn. And I told you, I'm long corn. Wheat, yeah, I wish I was long wheat. I missed it. Wheat. Go long the US dollar. I like the dollar in here. So again, corn, wheat, and the dollar. On the short side, playing it short, soybeans. And again, one of my earlier conversations, we talked about the correlation between soybean and corn and what's going on, but playing soybean short. Also short the euro. Also short high grade copper and the yen and the Swiss franc. So virtually, based upon fundamentals, your major currencies, the euro, the yen, Swiss franc against the dollar, basically are shorts. So looking for the dollar to strengthen, for those currencies to drop. And again, high grade copper. High grade copper, I think, has run a little bit. I haven't looked at that. In fact, I can look at it right now. But high grade copper has run a bit. Bear with me a second. Let me pull it up. I think high grade copper was up today. I'm going to the metals. Let's see. High grade copper was, high grade copper is up a little bit too. So, but again, those are my short positions. Little quick side note. And that is that, little quick side note, and the side note is that, I apologize. Little side note is that we have started some earnings in earnings season. So I'm going to talk about that as well as the secondary public offerings and another strategy. So we got a lot to talk about. I'm really excited about it. So I'm glad you're here. Let's see. I'm glad you guys are here, so let's get at it. All right. Last week, we talked about what we call the secondary public offerings. As I mentioned to you, I've made more money I made more money in secondary public offerings than I did IPO offerings. The reason being with secondary offerings, and I know I'm going to be redundant, but I need to make sure we get this before I go into our other area where we're going to make money. I'm excited because we're rolling into money-making season, so that's why I'm excited. All right, on the secondary public offerings we talked about last week, there were today, let's see if I can find them. Here it is. There was today, I can't find it. All right, my bad. I'm working off my computer and I'm looking for a certain file that I can't seem to find, so I'm not going to stress about it. All right, but working off my computer and looking at it, there were several secondary offerings today. There have been several secondary offerings over the past week or so. I put together a little chart, a PowerPoint that talks about these. I promise you I'm going to put some verbiage on it and post it on my YouTube channel. So just a couple of quick notes to rehash. There are two types of secondaries. There's what's known as a shelf offering. A shelf offering, again, is a secondary that was announced, that they did all the paperwork, they filed it, but the secondary itself, they can bring it anytime they want. So the paperwork's all been filed. They have up to I read somewhere else that said 3 years, but 2 years to actually bring it to the public. Now, why do I bring that up? let me give you the other secondary that you're looking at. And by the way, shelf secondaries are known as S3. That's the registration form, S3. So if you're looking at a secondary and you're not sure if it was a secondary was a shelf or a traditional secondary, which goes through the whole process of doing a road show or a week or 2 weeks to allow the investment bankers to get short. All right, so here's what's going on. You've had several secondary offerings that were basically just dropped on the market. I'm looking at a couple of them right now that are on my PowerPoint. One that was dropped on this symbol is BKI. They did a secondary. It was basically a shelf secondary offering. They dropped it on the books on June 15th at $70. Before they dropped it on the books, now make sure you understand this. They dropped it on the books and they priced the secondary offering at $70.25. They priced off the previous day's close. The previous day's close was at 74 and change. So they priced this thing $2 in the hole. At that point, they priced it. The stock it opened up at just below 72, right around 72. And from that day traded as high as 75. Went as high as 75. Now, when this happens, they drop stock on the books. A lot of times the market can't handle it and you'll see the price come down. Now this stock ran, and for us, anytime an IPO is priced or secondary is priced, that pricing number is an important number for us. If it breaks below that offering price, odds are it's going to go down further. When it comes back up through that offering price of $70, in this case, you can expect the stock to run. Now this stock ran to 75, traded 75 for 2 days, and then pulled back. And right now, well, I haven't looked at it today, but was back just above the $72 range. But it did never broke down to that $70 range. The next one I'm looking at, another one that did the same thing, was FOXF. Priced at 72. Again, shelf registration. They brought it to the market. They dropped it on Wall Street. The night before they dropped it on Wall Street, the stock closed at, let's see if I can get this now, 75, 76. The deal was priced at the low end of 76. I'm sorry, I'm wrong on that. I apologize. The previous day close was at $80, a little over $80. And then the next day it opened up, traded as low as around 76, and it's run from there. So 76 and all, we're going up to $81 a share. All right, those are just shelves. They just dropped on Wall Street. Wall Street just drops them on the market. Now, some interesting ones that Wall Street has time to plan for. And I'm just jumping. Let me find one that Wall Street had to plan for that kind of did what we expected to do. All right, here's Bill.com. IPO several weeks earlier. And by the way, the reason why the IPOs typically do secondaries, and I like the IPOs, is because I'm typically looking for stocks that are trading at or near their all-time high, that there seems to be a demand for the company, which means that if the stock comes to the marketplace, you'll see a demand for it. Now, the shelf registrations typically are not IPOs. They're not companies that have gone public relatively recently. All right, so I'm looking at Bill.com. Bill.com came public about less than a year ago. One of the stocks I tracked, made some money trading Bill. And Bill.com did a secondary on June 11th at $74.25. So that's where it was announced, $74.25. All right. Prior to the offering, the stock had traded down a little bit, then traded up. Offering came at $74.25 on that day. And then from there, the stock took off. And last I looked, the stock was trading somewhere in the mid 80s on its way towards 100. So this secondary that was dropped on the books gave investors an opportunity, a chance to get involved in the stock because the secondary put some pressure on it and it actually held it down. I'll give you another one. Let's see. What's this one? Again, your key number is the offering price. So DraftKings. We talked about DraftKings last week. DraftKings did a second day offering. They did it on June 16th. prior to the offering, at $40 a share, the stock was trading up with, mid 40s, traded down. This was one where the investment bankers were able to get somewhat short. Deal was priced at $40 a share, traded a little higher than 40. And remember what I keep telling you, the offering price is your number. It broke below 40. Once it broke 40, short it. It broke 40, traded as low as $30 a share. Now, if you made those quick points on the short side when it broke 40, that's great. If and when the stock goes back through 40, now understand this, the all-time high on DraftKings is about $45 a share. When it goes through 40, it's going to test that 45 and take it out if the market holds up. So once again on DraftKings, now DraftKings is broken down further than 30, so it's continuing to break down. But this is how the strategy works. So in DraftKings, in your defense on DraftKings, if you did short it when it broke the 40, you're still short. And I'm going to pull up one last one that I talked about. I don't know how to pronounce this. The symbol's IIVI. Stock was at 100, it split. It announced a secondary. It basically did the secondary. And what's interesting is the secondary was priced at 43 off of a 43, about a 43 close. But what you'll see before they did this was the stock was trading as high as $50. It had penetrated 100 before the split and then split. And they priced it at 43. I'm not sure where the stock is now. Let me pull it up. But the one thing I'll tell you is that the stock, in the stock right now, let's see, the stock, I'm looking at daily chart, the stock is still trading as low as $43 a share, closed it at $43.16. All right, so that's how you would trade these. I wouldn't touch this. The stock hasn't broke 43, even though it's in a downward trend. So once it digests this stock, hopefully it'll trade, this is what you look for. Hopefully it'll trade back up and back through and back up to the old trading range. But right now it's in the trading range between 43 and 46, and it broke 43. So back up a little bit. Again, on secondaries, we look for companies that are growing, that are doing well, that are trading at or near their all-time high, and then have decided to come back to the marketplace to raise more cash. All right, those are the ones that we like to look at. All right, so that's the secondary offering. The other thing I'll say to you, there were several secondaries that came today. The ones that came today were what we call the S3, which means that they were shelf registrations. They were in the biotech sector, and every one of them were priced in the hole. And what that means, they were priced below the closing price of the previous day. So they were priced in the hole, and those securities have continued to trade well and go higher. Let me see. I'm going to pull up one of them. Let's see. Secondaries. All right. So secondaries that were priced today. Bear with me a second. I've got so many things open on my screen for you guys that it just keeps me busy. All right. So I'm not going to waste too much time because I can't find what I'm looking for. Once again, that doesn't help you guys, but that's what's going on. All right. So those are secondary offerings. Before I forget, I posted Ping Identity. Ping Identity is doing a secondary offering. From what I've seen and the information that's coming out, it's coming tonight for tomorrow. So maybe you'll see it tomorrow. We'll see. Bear with me a second. I'm going to pull up a chart on Ping for you. Just discuss it real quick. So Ping announced this secondary offering. They announced it. They're not selling stock. The insiders, the shareholders are selling the stock. It's a secondary offering. Ping Identity went public. Stock's doing extremely well. The secondary has been announced. This is a normal secondary. It was announced over a week ago. Actually, it was announced on July 2nd, I believe it was announced. So you saw the stock at the time was at $34 a share, traded down to 31 and change. It closed the day at 32 on a little rally on some decent volume. Again, I expect two things. One, to this be priced in the hole. Two, once this stock is digested, I'm expecting this stock to run. All right, that's what we're looking at. So that was priced. Another one that was priced today, which was a layoff. It was a shelf registration, priced at 26.70 cents in the hole, and the stock ran today and closed as high at $30.97. So it was priced. The previous close was $28. It was priced in the hole. Stock opened up north of 32 and closed at $30.97 on the $27 close. So again, what you're seeing is you're seeing the market after they digest this stock a lot of times, they're going to run it. All right. That's the secondary stock market. Again, I gave you some sites you can go to where you can actually find and track these. I do track these. I look at them every day. I look at them every night. Again, I'm going to repeat this again and again just so you guys have it. And I'm writing it down too so I can remind myself for you. And that is one, on secondaries, the offering price on secondaries is your price. It's where you're either going to use a stop and get out, or it's where you're going to get in. So if a secondary breaks its offering price, that means that the investment bankers step back, they can't handle the pressure, and the stock's going to come in. Now, that might be a point, might be 2 points, might be 3 points, maybe more, but the stock's going to come in. The other side is if the stock opens up and breaks above the offering price, or when it does go above the offering price, that means that you should go ahead and buy it. It's digested all the stock. The market's ready for it. Whoever's going to sell is out the way. Go long and trade the secondary. All right. Now, if you are long, I got to back up again. If you're tracking a secondary that's announced they're going to do a secondary, and the secondary is a S1, which means they're going to actually take time to go short, take time to work with it. If you're actually tracking an S1, and I can show you, and I do show you how to see if it's S1. If the stock is doing an S1 secondary, what it means is when they first announce it, the market is going to short that stock. The investment bankers are getting short, and the market's going to short that stock because they know the price is coming in. Now, I'm pulling up Ping. And as I told you, on July 2nd, Ping was at $33, $34 a share when they announced it. Stock traded down to 31 bucks. I've seen bigger moves to the downside. But again, 2 points, 3 points on 1,000 shares is not a bad trade if you're doing it only for that day or 2-3 days. Now, if you're short Ping or you shorted Ping ahead of the secondary, and that's probably what you saw today, you saw some covering. And the reason why you saw some covering is not all the institutional investors, as well as the investment bankers, are going to get deal stock. So they're covering their short to lock in profit. So again, if you short a secondary before the actual secondaries is coming to the marketplace, and you get 2 or 3 points or more to the downside, cover and lock in your profit. What it means now is that you have a $2 or $3 profit. So if it's 1,000 shares, you got a $2,000 or $3,000 profit to trade around before you go long the security. Let me say it again. You're going to trade this like the investment bankers. I know I went over this last week, but I'm just saying it again. On an S1 secondary, when you see it announced, you start tracking them, guys. You'll see that the stock will start to come in. The reason why the stock starts to come in is because the investment bankers and people like myself are going to short that stock ahead of the deal. Why? We know the price is going to come down in most cases. There's always exceptions, but in most cases it's going to come down. Just before the stock is about to be priced, again, Ping is supposed to be priced tonight for tomorrow. So today is when you would cover Ping if you had your 2 or 3 points. The old saying on Wall Street, bulls make money, bears make money, pigs get slaughtered. So again, once you get short that stock and it comes down 2 or 3 points, take your 2 or 3 points, Again, 1,000 shares. And I use 1,000 share blocks because it's easy to do numbers. Take your $2,000 or $3,000, put it in your pocket, close out that or after you close out that short position, and then sit back and wait and see if you're going long. Now, with that said, there have been times when I went short ahead of a secondary and stayed short on the secondary because I saw the price and I saw it was loose, and I decided to stay short and rode it even lower. But at some point you're going to cover, and if after you cover, again, if we're using that IPO price, if it doesn't hold, once it breaks below, if it doesn't hold, if it starts to go back up and goes through that offering price, I'm going to get long. All right, I'm going to say it all again. I'm not trying to confuse you. I'm trying to drive home a point. How we make money. First, as soon as we find out the S1 has been put out there, and you guys, I showed you where you can track it. You can just track it on the news, track it on stocks. But as soon as you find out the company is filed a S1, all right, you can actually look at the stock and look to get short. Short means you're playing for the price to drop. And I'm telling you, the price is going to drop. As the price drops from the investment bankers, from the getting short, you want to be short too. Pick up those 2 or 3 points on the downside. Keep tracking the stock, find out, and they'll announce it. This is all public information that the company, the stock, they're planning on pricing the stock tonight for tomorrow. When you hear that, you can do 2 things. 1, lock in profit, put the money in your pocket. 2, if your position's big enough, which I've done that too, lock in some profit on a couple of thousand shares and let the rest ride. Because if the thing really priced in the hole and comes in, it could really come down. Now, the second thing I'm going to say to you is the kind of stocks that we're buying and trading the secondaries are in companies that we want to own even if they weren't doing a secondary. Stocks that are setting new highs, that are having explosive earnings. So that the reason why I'm telling you this is the stock's not in trouble. You just found a near-term situation where there's some softness in the price and it's coming down. As soon as the market digests that stock, it could be the same day, it could take 2 or 3 days or a week. But once the market digests that stock, if it's below the offering price and it goes back up through the offering price, you want to get long there too. All right? That's how you make your money. I mentioned to you guys, and I'm pulling it up now, I mentioned to you guys Ring, RNG. I'm trying to remember my dates. God, it's been a while, so I got to make this chart a little bigger. I believe I went long September, November. I believe it was, I'm not sure. RNG did a secondary, and I'm not going to look it up because we don't have time. RNG did a secondary, Ring. I went short the stock ahead of the number, went long the stock after the number. After they digested most of the stock, most of the stock that was done on the secondary took off. I did the same thing with CTXS. Okay, that didn't work. CTXS. My fat fingers. Same thing with them. I believe the secondary was around 140, I think. I made money on the short side ahead on shorting it, and I made money on the long side. All right, leave that alone for now. Again, I'm working on the PowerPoint. I will post it. So I'll post all of them. I'm about a week behind, so I'll have it posted hopefully by the end of this week, as well as working on this week's that I'm doing now. All right, so that was what I'm talking about on secondary public offerings. And that interesting. I got a half hour to start this. So let me put this in front of me and start again. We are moving into earnings season. Earnings season is when you see a stock pop up or down. To give you a prime example, Levi Strauss, the jean company, reported earnings today. They missed the number. Revenues became in better than expected, but they missed on earnings. They had some charges. And as I keep telling you guys, one of the things I need to tell you, which I keep telling you, is this coronavirus is going to have an impact on a lot of these companies. So when Levi Strauss announced their number, they also announced because of the coronavirus, their sales have dropped by some, I don't remember what the number was, but 20%, 40%, but the sales had dropped. and they were lowering their estimates going forward. And that's why the stock was off today and got hit. All right, we're going into earnings season. Now, one of the things I looked at when Levi Strauss, and I'll do it real quick since I'm here. One of the things I looked at with Levi Strauss was, and you should look at this too, Levi Strauss ran from $12 and change to $14 and change last week. Yesterday, ahead of the number, the stock came off on almost twice its average daily volume. The market knows things that you and I don't know. The market knows things that are going to happen before they happen. And if you sit back and watch and listen, a lot of times they're going to tell you what's going to happen. So just ahead of the earnings, Levi Strauss's stock went down from 14.20 to about 13.60, but it did it on twice the average daily volume. They announced earnings on the before the market opened today, and the stock opened up at 13 and change, $13.12, and it's been as low as $12.55 on 5-6 times the average daily volume. There's probably more pressure coming behind this. You can't have that kind of volume and the stock have a gap down. Now, don't get me wrong. If all the selling came out, the stock might have a little bounce, what we call a dead cat bounce, to try and fill that gap between 13.75 and 13.25. But after they fill that gap, there's probably going to be more weakness to the downside because they've come down and they've lowered numbers. They've lowered their fundamentals. And if they're lowering the numbers, that basically they're lowering the valuation of the company. All right, so how do we play earnings? First and foremost, and as I say this to you guys, I'm not telling you what to do, but I am telling you that if I were you, I'd be writing this down or listening to the broadcast several times. And as you listen to it several times, you're writing it down. First thing you want to do when you're doing an earnings play is you want to find the companies that historically in the past have beaten earnings. You also want to look for companies that have beaten earnings that are in what we call a hot sector or one that's doing extremely well. And you want to make sure that they're close to or at their all-time high. Now, I'm saying a lot of things here. We're looking for a special breed. We're looking for basically the best breed, the best companies in the hottest sector or hottest industry. We're also looking for companies that have a history of beating the number. All right? That's where we start. So first and foremost, the reason why I told you to write this down, you need to take a pen and paper and go find the stocks that fit that criteria. 1, trading at an all-time high. 2, that are in a hot sector or industry. And 3, you want to make sure that that there's volume behind it. So again, what industry, hot sector, have they been beating earnings in the past, and the stock is trading near its all-time high? This is where we're going to start. All right? Again, this is where we're going to start. That's our starting place. So in other words, what we're doing right now is we're looking at the stocks that we want to actually look that we might actually buy. And the reason why we might buy them again is because these stocks are doing so well fundamentally, and the stock price and the fundamentals seem to be working together. That means as the company's doing better, the stock price is going right with it. I've seen companies that the company's doing well and the stock price is going down. I've seen companies where the company's not doing well and the stock price is going up. We want both. We want the fundamentals and the technicals. Okay. Now that you do that, this is your list. By the way, guys, I'm not here to approve or disapprove of your list. I'm not here to tell you that this stock's going to go up or go down. Like everyone else, I have an opinion. I'm sharing my strategies with you, but there's a number of times, where you're going to disagree with the experts. And you're going to be right, and the experts are going to be wrong. So don't think just because you started doing this and you've only been doing this for a month or 2 months or a year, 2 years, that you can't make smart and good decisions. And don't think just because somebody else has been doing this for 30 years that they know all the answers, because they don't. So have some faith in yourself and write these notes down and stay with me. All right. Once you find that company that you like, companies, because I want you to do it with more than one company. So once you find the companies that you like, the next important thing is, and I hope you guys are writing this down, what date are they due to report? And they can report, there's two times they report, either before the market opens, and you'll see that labeled as BMO on some of these websites I'm about to give you. So again, BMO, which is before market opens. Or the other one is after the close. So, before the market opens or after the close. Now, where can you find this information? There's a couple of sites you can go to, and I'm going to give them to you. I'll write them down later, but I'll give them to you now, and I'll say them slowly. Earnings Whisper. EarningsWhisper.com. Zacks, ZACKS.com. FinViz, FINVIZ, FinViz.com. And the last one, which is a site that I never, ever talk about with my students, but they all use it. And the reason why, because they know I don't like it because they buy their data, but that's okay. And a lot of times they're buying the data from Zacks or someplace else, is Yahoo Finance. When you go into Yahoo Finance, you want to go to the analysis, and that's where you'll find your earnings estimates. Now, the reason why I gave this information, one, you need to know what Wall Street's forecasting for the earnings. What is Wall Street looking for? You need to keep an eye on that number too. Earnings Whisper will give you what Wall Street's expecting, and they'll also tell you what the whisper number is. So what's going on with a whisper number? Here's the deal. When Wall Street decides they're going to write a buy report or sell report on a company and put in what they're forecasting for earnings, that report can take several days, several weeks to write. I've got some students here who write reports, and they'll tell you after they write the report on the new information they got, then they have to get it approved by the investment policy committee, or they have to get it approved by somebody else to make sure that it's all compliant and there's no other problems there. Then they publish it. What happens with earnings, especially whisper earnings, these analysts who follow the company don't have time to write a report. And what they'll do is they'll pick up the phone and call their best client. Their best client's not me and you. Their best client's some mutual fund, some hedge fund that's going to buy a couple thousand shares and generate some commission for the firm. They're calling them. But at the same time, as you can see by volume, those are the guys that move the stock. They move it up, they move it down. So you're going to go to these websites. You're going to find what the companies expect. You're going to find what they're expecting for earnings and revenue, and then what the date is of when the earnings are due, whether it's before the market opens or after the market opens, but the date. All right, that's what you're going to do. Now, homework time. And I'm trying to get a lot of this in. Again, I'm looking at my clock. I've got like 15 minutes, I think it is. No, 20 minutes to get this in, but I'm going to get it in. All right. Now that you found the stock that you're interested in, you found when they do the report and what the numbers are for earnings and revenue. The next step is to go find all the major competitors that they have in that industry. And you don't want to pick somebody just because they're in the same industry. You want to do your best to find their competitor. So if I'm doing this with Intel, I want to see what AMD and NVIDIA is going to do. If I'm doing this with Ford, I'm looking at General Motors numbers as well. Tesla's numbers, Ford. I'm looking at all the autos. So whatever stock company you're looking at, you want to go out and find their closest competitor and do the exact same thing. When did they do the report? What's the numbers that Wall Street's looking for? Now, if you're lucky, one of your major competitors of your company will report their earnings before your company. And when they do, you want to be all over that. Reason being is they're all in the same industry. So if your competitor reports before your company, and in their announcement, in their earnings release, They're going to give you the forecast for the current. They're going to tell you what they did this quarter or previous quarter and what they expect this quarter. If they say something to the effect of, we had a great quarter, the industry's hot, we couldn't sell it fast enough. If they say certain things, then what they're telling you is the industry's hot, not just them, but the industry. So if the industry's hot and they blew out the number, odds are your company's going to blow out the number. All right, this is where we're leading to. You're looking at the competitor to get an idea of what's going on in the group and the industry. Now, if the major competitor that comes out before your company and says it was a rough quarter, I'm making this up. Coronavirus cut our revenue back by such and such. We're not sure how we're going to recover from this. Earnings going forward are probably going to be soft for the next 2 or 3 months. And you see the stock sell off. What do you think is going to happen to your company? And what you'll notice is if you do this, you'll notice that your company will start to trade based upon what happened with the competitor before they even get to your number and the date when they do the report. So let me say it again. I'm going to give some examples. I'm in Intel. I'm looking at NVIDIA. All right? Intel reports before they do. Intel comes out and says the chip industry is doing great. The gaming chips are, the gamers are still buying chips. In fact, because of the coronavirus, we're seeing more people staying inside and playing more video games and demand for chips, blah, blah, blah. Again, I'm making this up, guys, but you get the idea. Now, if Intel says that, most likely NVIDIA is going to see the same thing because they, in theory, from what I'm told, make a better gaming chip. So we're tracking it now. We're tracking the industry. The other thing you're going to notice is, I want you to start doing this, when you find the company that you want, you're going to do 2 things. You're going to track the price and volume. And you're going to track the earnings releases or the forecast. So what happens? As we move forward, analysts will start either raising their forecast or lowering it. You'll see that sometimes. So if we're seeing a company that before they actually announce the earnings, you're starting to hear analysts raise the number, that's a plus for you. The second thing is, and the reason why you want to track it is, in a number of cases, you'll see the stock start to trade up to new highs or higher ahead of the number. Again, it's Wall Street positioning themselves to what they think is going to happen with the number. Checking my time. Let me add a point to this. I'm smiling, I always smile. When I think about making money, I start smiling. It's just me. I make a point to this. When the number comes out, there's 3 things that can happen. I'm giving you real straight and simple. 1, stock goes higher. 2, stock goes down. Or 3, the stock just trades sideways. Let me give you all scenarios again. 1, stock trades higher. What it means is that the number blew away what Wall Street was looking for. Investors see it. They're going to actually increase the value of the company because the revenues are higher, the earnings are higher, they're better than what was expected. Stock's taking off. It's going to run maybe 2 or 3 days. When the stock finally stops running, it's going to have a pullback. It's going to have a pullback. It's only natural. And the reason being is there's a whole group of investors out there, which is what you guys are becoming part of, that will jump into a stock ahead of the earnings, get the number they're looking for, get a 10, 20, 15% return in 2 or 3 days. And then as soon as they get that profit that they're looking for and they see the stop running, they're going to sell it and pull out. And then moving on to the next earnings report. They're moving on to the next company. We're in earnings season. I've done it myself where I love a company, I'm there, but I got to pull that money out because I don't have unlimited capital. And there's another stock that's due to report that I believe is going to blow out the number and I want to get long that one. So that's what's happening. So you want to track the stocks before. Now I've got a bunch of students on here watching who've been in class with me and have heard me talk about this strategy. And they'll tell you that I literally would give them an assignment where they got to track stocks ahead of the number, and then we came into class and discussed what they saw with the company before they reported, what happened when they reported, what happened after. Become a student of this, all right? This is what happens. Now, going back to the company that blew out the number. They blew out the number. Stock ran. Profit taking came. It pulled back. And then guess what? If the market holds up and everything's going well, it's going to run again. And by the end of the quarter, allow yourself 3 months, you're going to see a significant move in the stock. If it's a stock that has that kind of power, that's why you want to find a hot stock in a hot sector. All right. And again, which I talked to before, the reason why I like stocks near new highs is that when they break through that high, there's no resistance above them. So we should continue to see the stock run for a minute. Now, if the stock comes in and goes flat, what it means is that they reported exactly what Wall Street expected. They came through and they made the announcements. They had their earnings, their conference call, and they talked about it. And pretty much everything's exactly what Wall Street was expecting. Nothing big, nothing new. So the stock basically just, traded sideways. Then the other one is they missed the number. I want you to think about this now. All that fast money that moved into the stock ahead of the earnings, waiting for them to report the number, expecting them to have a better number. And if they miss it, they're all coming out. I'm coming out of the stock, you're coming out of the stock, and the stock's probably going to gap down and go even further, which is what you saw with Levi. So again, on Levi Strauss, they announced the number. The previous day, which was yesterday, the stock closed at $13.80. Earnings were announced overnight, and this morning the stock opened up at $13.17. And then from there, it went down to $12, as low as $12.50. Now, for this is this is not a tech stock. It's a retailer, basically. They sell jeans. So we're not expecting the stock to run, but you can see what kind of pressure the stock's under. And again, that's what's going on with that. All right. I'm going to add to this now. Let's go back. And one of my good friends up here, Gene, thank you so much. Gene asked me about Nike. Nike just reported. I didn't look at the number. I can't remember the number. I got too much on my mind. So welcome, my boy Gene. But here's what I'm going to say about Nike. Let's say Nike's due to report and you like Nike. All right, Nike's going to report, let's say 2 weeks from now. No corporation in America is an island by itself. Nike is not an island by itself. There are vendors who supply Nike, and then Nike supplies retailers, customers. We need to know who those people are. There are certain websites, and you can actually just, I did this, I tested this. I can go into Google, type in Nike and type in the word competitors, and they'll give me a list of Nike's competitors. It's amazing what you guys can get off the web now that I had to do the long, hard-headed way. But again, here's the deal. Oh, Nike's competitors, Nike's competitors, Nike's vendors, and Nike's customers. You can type all that into Google. Nike's vendors, Nike's customers, and you can find out who their major customers are. They pull it right out the annual report. So here's Nike. Nike buys their, again, I'm making this up. I want you to make sure you understand this. Nike buys the rubber for their sneakers from this publicly traded company that's over in the Far East. Let's call it company XYZ. I also find out that company XYZ is due to report earnings a week before Nike. I'm tracking XYZ's earnings and revenue. Why? Easy. Nike's their biggest customer. If their sales revenue is up and growing and they come out in the conference call and say our earnings are up, sales are up, we're doing great, you know it's because they sold more rubber to Nike. And if Nike brought more rubber, it means Nike made more shoes. If Nike made more shoes, they probably sold more shoes to the public. So because one of their key vendors has blown out the number, odds are Nike's going to blow out the number. Now, let's say that Nike, again, I'm making this up, sells all their shoes through, who am I going to pick on? You guys all are interested in Gap now because of Kanye West. So Nike sells all their shoes to Gap. Gap is the main distributor. They're Nike's biggest customer. So if Nike tells us, and we see that their vendor has a great quarter, Nike has a great quarter, then we know what? Nike sold more sneakers, so therefore Gap's probably going to have a great quarter too. You have to become what I call a finance detective. No corporation is an island by itself. We all buy supplies we all have vendors, and we all have customers. And even though you might not tell me how you're doing, I can find out from your customers. I can find out from your vendors. So it's what we do. So all I'm saying to you guys is, this is the process that we do. This is how I do it. All right. So, quick review. Just checking my time. 8 minutes. All right, good. Quick review. We're going into earnings season. Your homework, take out a pen and paper. Go find some companies, one, that are doing extremely well. And by the way, when I say extremely well, they're not only meeting, but they're beating their earnings expectation. They're beating their revenue expectation. Wall Street, the stock is doing well. The company's doing well. It's something that you want to own before the company. You want to own the company, whether they're announcing earnings or not. You're looking and say, "Wow, this is a great company." All right. So that's what you're looking for. Now, one of the things I'll also track is I'll go back and look on I'll go back and look on charts. And my charts that I use different services, but all of them will let me know when earnings were announced and what the earnings were. And then I can actually see how the stock traded ahead of the earnings and how the stock traded after the earnings. There have been stocks in the past that I have turned down because they blew out the number. I knew they were. The number was there. And I looked and said, in the past when they beat the number, the stock only went up 2 or 3%, 4%. So I'm not looking for that kind of move. As I told you, I'm looking for triple-digit returns. I might be the first person that said it to you. Some of my students who are on the line have heard me say it and seen me talk about it, and some of them have put up triple-digit returns. So I'm not making this up, but I'm looking for triple-digit returns. So that's what I'll do with the stock ahead of the number, after the number. By the way, I think Nike, I'm pulling up Nike now. Yeah, Nike reported on June 26th, and I'm looking at what the stock did. The stock opened up, so I'm going to assume it was on the open. The previous day, the stock closed, it looks like at 99 and change. Next day, opened up at 98 and went as low as 93. Now, the stock's trying to fight its way back. I don't know what the earnings call said or what they said, but whatever it was, Wall Street didn't like the number, and that stock sold off. And believe it or not, it gave you plenty of opportunity to get short if you wanted to get short because the number, it opened up at 98. And I'm looking at the volume. So the volume is what, 2-3 times average daily volume right there. Okay. All-time high. Oh, hot sector, hot group. Check on it, follow it, track the stock. What I used to have my students do, I had them keep a journal. And in the journal, earnings journal. In this journal, they would write down what the number was they were looking for, what the stock price was on that particular day. And by the way, I used to do it in a spreadsheet, not an actual journal. What the stock price was when I first started following it, what the stock price currently is. I would track that. I would track if there was an update to the number, and I would track them. I would put them in groups. I would put them in groups on my spreadsheet where all the stocks were the same together. In other words, all my tech stocks, all my semiconductor stocks were in a group, all my sneaker companies were in group. I wanted to track them as a group. And I really wanted to track the ones that went first. And it reminds me of a story. I was tracking Goldman Sachs. I was tracking Goldman Sachs ahead of the number. And Goldman, I was actually looking at Legg Mason. Legg Mason is no longer public. It's privately owned. They merged. But I was actually looking at Legg Mason. Goldman reported maybe 2 or 3 weeks before Legg Mason. And Goldman blew out the number. When Goldman blew out the number, they said that they blew out the number based upon the fact that their money management, their advisory side, their portfolio management blew out the number. They were just making, it was growing, was doing extremely well. And that was what really drove the revenue and earnings. Now, Legg Mason was a smaller brokerage firm, but they really specialized in is asset management, portfolio management. That's what they did. So Goldman blew out the number. I looked at Legg Mason, didn't budge. I don't want to get too sophisticated in terms of what I did, but I for those who follow, I sold an at the money call and took that premium and brought 3 just out of the money calls, 3 of them. And I actually put some money in my pocket because there was no volatility in the options. And I sat back and waited. And when that number came out, Legg Mason blew out the number too. And they blew out the number, and that position I had put on, I don't remember the number, but it was close to a triple. All right? That's what we do. That's how we do this. Track the companies that you can that in the industry and the group that are going public not going public, that are about to announce their earnings and their revenue before your company, hopefully in the same group. Now, the reason why I also mentioned that is I knew Goldman Sachs reported early in the quarter. Goldman Sachs is one of those companies that they report almost as soon as the quarter is over. So they report early out of the financial companies. Goldman usually reports first. Okay, now where do you check volume? On any chart that you look at, the chart's going to have volume on it. Anytime you go to any of these websites and you start pulling up what they call statistics or the profile of the company, they'll all show what the average daily volume is. And they'll tell you if it's for trailing 20 days, the last 20 days, the last month, but they'll tell you how many days back it's trailing, and they'll show you what the average volume is. And then when you see it, when you look at a chart or you look at that information, you can see that the volume has been substantially increased or decreased or whatever the case may be. On my charts, I'll even run a 20-day moving average on my volume, just so I can see what's happening with volume. All right. Let's see what else. I got my question on volume. I got that. Before I forget, some of you came here late because I got a minute. It's going to shut me down. I got a little over a minute. There's a part 2 to every time I lecture, I talk to you guys. So I take this, I'll record this. I'm recording it now. I'll post it on my YouTube channel, Professor Milligan. But I'm telling you right now, I come into my office, I sit down, and then I take what I talked to you about on this video, and I put together a PowerPoint presentation, PowerPoint video, that I'll also post with it that I actually give you the visuals, because I'm looking at visuals now, but all you guys get to hear is my voice. So when I post my part 2, it's going to actually have the visuals that I'm looking at. It's going to have visuals so you guys can see what I'm talking about. I usually take a snapshot of the screen so you can actually see what's on the screen. So I'll take a snapshot of, for argument's sake, Zacks, and a snapshot of FinViz so you guys can actually see it. All right, with all that said, thank you for following me. Again, you can follow me on Instagram. You can follow me on YouTube. Please do follow me. And by the way, when you guys start making money, when you're making money, please share it with us. I have no problem with you guys showing us how you're making your money, where your money's coming from, what you're doing, what worked, what didn't work. So feel free to share. All right, have a blessed one. I'm out. Talk to you guys later.